In this video, I'm going to cover the question that somebody asked me, which is, please can you do a video on refinancing and taking your cash out? Watch it to find out the answer. Question from somebody saying, please could you do a video on refinancing and pulling your cash out? So this is the basic buy, refurbish, refinance and rent model. And it's a model that works really well. So simply speaking, what you do is you buy a property, you renovate it, so you add value to it. Once you've added value, you then refinance it to try and pull all your money out. Once you pull all your money out, you've got the property there with some equity left in there, and you've created regular cash flow and a capital appreciating asset. So that in simple terms is what you're looking to do for a kind of a single let. Harder to do because you're not going to add that much value as compared to a bigger project, and I'll explain how in a moment. But also buy-to-let funders, once you've refurbished it, won't usually refinance it for you until after 6 months. So you're gonna have to wait there. If you're doing a commercial conversion, for example, a lot easier, because usually you'll have more than one unit. So you'll have 2, 4, 6, 8, 10 flats, so depending on the size, obviously more flats. Once you've done that, you'll have added more value. You can then do a title split. So if you've got 18 units, for example, you create 18 different titles, because the value of each individual one separately is going to be higher than it collectively. Then you refinance, and what will happen, again depending on how much value you've added, but generally speaking from my own experience of all the deals that I've done and my clients do, the majority, like 90%, end up pulling all their money out. So I've got other videos here. If you look at the Boston project, you'll see I've done that there. If you look at the one on St. Paul's Road, I'm just about doing that now. If you look at New England Club, we're doing it there, and there's some other projects that we're working on as well, which will be exactly the same. So just to recap, to keep it simple, it is investing in a property, adding value, then pulling all your money out, and the value that you've added, you leave some of that in the property as equity, because you don't get 100% funding, so you might get 70% or 75%, for example. So the other 25%, even if that's the extra value you've added, you leave that in there. You pull all your money out, you can then use your money to recycle into the next project, and because you've refinanced, there's no tax to pay per se, because you've not sold the asset. So you've paid no tax, and you're only going to pay tax on the profits of the rental income, and you can move forward and do more projects and keep recycling your cash. So that's what it is. I think it's a beautiful model, fantastic model, and use it as much as you can, because it works beautifully.